Value stocks have had a tough 2017. Despite a turnaround in early September, S&P growth stocks, up 19% year-to-date, are still trouncing value, which is up just over 8%. But conditions are changing, which may be putting the value back in value investing. Let's take a look. We have long believed that investors will be compensated for buying low price-to-book value stocks. Now, this is intuitive. If you buy something with a low valuation, you're pricing in a higher expected return. History proves this out, and there's ample empirical evidence supporting the value factor. We know, however, that it doesn't work all the time, and 2017 is no exception. While it's difficult to time the market, there are periods when conditions are more conducive to certain kinds of stocks. For example, when growth is relatively dear, investors will pay more for companies that can grow. That's the kind of period we've been in this year, with growth seemingly stuck below 3% and the pro-growth policies out of Washington yet to materialize. Over the course of the year, investors had scaled back their expectations for interest rate increases accordingly. This had driven investors into traditional growth sectors like technology and healthcare, which have gained 26% and 20% respectively against the S&P 500 gain of just under 14%. Recently, however, expectations have begun to change, with economic growth improving and both interest rates and the dollar rising. The 10-year Treasury yield has risen 17 basis points in the last month, and the probability for a December rate hike has risen to just over 2/3. Further, recent news out of Washington suggests a renewed focus on tax reform and fiscal stimulus, and inflation expectations have risen as well. Now, these are conditions that historically favor value investing, which has a cyclical bias. Like all investment strategies, including a passive strategy, value investing requires patience. While the value factor remains a way for investors to improve their performance over the market, it can experience prolonged periods of underperformance. We recommend combining the value factor with other compensated risk factors like size, quality, and momentum. There are important diversification benefits to be gained in combining factors, and doing so can mitigate the risk of underperformance associated with any one factor.